In today's video, I am going to talk about someone I've been working with for several years now, and he funds his whole life insurance policies with a total of $590,000 per year. He's got a wife and two kids, but he's aggressively funding the policies. However, what's interesting about his situation is when he was first introduced to whole life insurance and he was exploring it to see if it was a fit for him, he said no. Then 4 years later, he revisited it and decided to proceed. But again, in the beginning, he said no. A lot of times people look at that and say, hey, that's 4 years of lost time. So what I want to cover is first, why he said no, what initially interested him in whole life insurance, what he was proposed, and again, why he decided not to move forward, and then why he did move forward 4 years later because it was a whole life insurance policy. He was looking at the same dollar amount going in, but the numbers looked much, much different. And this is one of the most important things to understand when it comes to a whole life insurance policy is making sure the numbers are set up correctly. What that means is when you pay money into a policy that is designed or set up properly, where you've got rich cash value right out of the gates. So we'll talk about exactly that as we progress through today's video. But let's begin with a little bit of information on his situation. So when he first looked at whole life insurance, he was 40 years old. However, he started his first policy at the age of 44, 4 years later. Now, him and his family do well financially. He's an executive in the tech field. A quick side note, he's extremely analytical. He had a number of questions. He wanted to have several discussions before moving forward with policy number one. And he's analytical by nature. So anytime questions come up or anytime he's doing research on whole life or any area of finance, he spends a lot of time really trying to understand the product or service inside and out before he allocates some of his money toward it. So it's his money that he's dealing with. So he wants to make sure everything's set up correctly. Now, his wife also does well. She's an attorney. So they do well financially, and they're in a position where they don't need to put money into cash value life insurance. They've got other investments. They're well diversified. They've got excess funds in cash. Again, they don't need the product, but they were attracted to it because they saw how it could benefit their current financial position, or how really it could enhance their current position. So let's talk about 4 years prior to him and I connecting. So when he first looked at whole life insurance and said no, it was with a different company, a different agency. At this point, I had no clue who he was, and he had no clue who I was. So he was interested in whole life insurance primarily due to infinite banking. So he had done a lot of research, and this concept, infinite banking, bank on yourself, the idea of using a high cash value life insurance policy as a financing tool and being able to leverage that cash value instead of going to banks where you can borrow against your cash value and the entire cash value, any money still in cash value, and what you've borrowed continues to compound for you. That's what he was attracted to. The mindset often here is, hey, I can pump a ton of money into this life insurance policy, have this bucket of cash value compounding for me, and then when I have needs for financing, instead of going to a bank, which can cause a lot of delays, especially if I have a large real estate transaction, I can just use my policy as a line of credit. So that's what attracted him. That was the interest that drew him to whole life insurance, but he decided not to open a policy, even with the benefits that come with the cash value, because he didn't see the value. Now, the follow-up question here that I had was, well, where was the value missing? Why did you not proceed specifically, especially for someone who's analytical in his particular case? So here's the exact reason, and here's what most people bring up when it comes to whole life insurance, specifically as to why they do not do it. So the reason for not starting a policy was a loss of capital, too much. Specifically, he looked at an example of $100,000 per year going into the policy, and the first year cash value was between $40,000 and $60,000. Take the high end, $60,000. He pays in $100,000. In year one, he's got $60,000. How much of a loss is that? $40,000, a 40% hit. It also took between 7 and 9 years to break even. What that word break even represents is when your cash value is equal to or greater than your total payments. So for example, if he's paying $100,000 per year and he does that consistently for 7 years, by year 7, he's paid in $700,000, 100,000 times 7. So if his break even point is year 7, that means the year 7 cash value would be at least $700,000 or a little bit more. So he looked at it and said, okay, I see the benefits here with respect to being able to borrow against the policy. I like the loan feature. I'm attracted to that. However, I am not willing to give up $40,000, perhaps even more of that, to attain that. And then on top of it, I've got to wait 7 to 9 years just to see a positive cash value. That means I'm running a loss those first 7 years. Like I'm not doing that. I'd rather do other things with my money. He decided not to do it because it was too much of a hit on his capital, his money going into the policy. And that right there has always been the objection with whole life insurance. When we work with individuals and someone asks, why do people not do this? That's why. The policy is not set up for high cash value. They take a loss right out of the gates and it takes too long to recapture their capital. The thing that they're not shown is that you can work around that quite easily. So let's continue on. He revisited whole life insurance 4 years later. Okay. Questions and discussions were 100% around the cash value. That's what he was interested in. Specifically, how do I maximize it? He brought up the fact that he looked at it 4 years ago and decided not to proceed with it, and he provided this information. That's how I know about that. But he was not interested in a policy that looked like what he had seen before. So how do I maximize it? Again, specifically the cash value. And then here's a question that came up. Why are the examples you are showing me look so different than what I have seen before? So that's very important there. Let's take a look at what he was shown. So if we rewind a little bit and go back to what he was proposed and decided not to proceed with, we're going to look at an example of this. Now, this is something I put together that is close to what he was proposed, but it's not the exact same illustration. But you'll see exactly what I'm doing here, and this illustrates what most people go through when trying to find the right whole life insurance policy. So the original proposal is as follows. He had how much per year going in? $100,000 per year. When you allocate money to a whole life insurance policy, you can choose where your money goes. It can go toward the premium or toward the PUA rider. PUA stands for paid up additions. So here we've got a $40,000 premium and then a $60,000 PUA rider. And you'll notice that the PUA in his particular case was only funded for 5 years. So add those two together, his total funding is $100K per year. What I will add about whole life insurance policies, when you look at the premium piece with a traditional whole life insurance product, when I say a traditional whole life insurance product, that means a product that the premium is payable or due until age 100 or 99 for a very, very long period of time. You don't have to pay it that long. You'll see it in this example. But that is a traditional policy. The premium dollars on traditional policies do not show up in cash value in the first year and sometimes the first and second year. So what was that objection he raised? Why did he not do it? He saw $100,000 of his money going into the policy. These terms can confuse people. All he sees is the bottom line. 100K goes in, and right out of the gates, I've got $59,000 in change, call it 60 grand. There's my $40,000 hit. This is often what people look at and say, why? Why would I do this? Or can this be improved? Because that's a big loss of capital. Like this is someone's money going into the policy. So when we look at this, here we go. Pretend this is you. You pay in 100. First year, you've got just about 60. The next year, you pay in 100. It grew from 59 to 162 and change. So a benefit to year 2 is you got your full $100,000 back that you paid in year 2 because if it was 59 and you added 100 to that, it'd be worth 159, but it's worth 162. So you got your money back and a little bit more, and it picks up the pace, but it takes some time here. It's not until years 6 and 7 where we break even. Year 7 is our break even point. So we see his funding plan was to fund $100,000 per year for 5 years and then drop to the premium payment of $40,000 per year through the 10th year. He could go longer, but he was interested in a 10-year funding scenario initially. So there's an illustration, and we pulled this from the actual illustration when I put this together. So this is the exact same illustration we just looked at. Okay, but back to Excel. This simplifies things in my opinion. So his question, why are the examples you're showing me look different from what I had seen before, what I was shown 4 years ago? Here's what got him to move forward, and we're going to look at the examples. So, and again, this got him to want to move forward, not just move forward, but he looked at it and says, hey, I want to do this. So the first year cash value was between 85 and 95%, 85 and 90%. That's instead of 60%. Same out of pocket. We're going to look at the exact same product with the exact same company and improving that. The break-even point between 3 and 5 years instead of 6 and 7 years. Flexibility. This is a huge one. I'm going to talk about this more when we pull up the numbers. He's funding $100,000 per year. That's what we saw in blue on that Excel workbook. But guess what he's billed for? The minimum premium. Now it'll be a little bit more than that. His might have been $11,000 or $12,000 per year because we have to add term insurance and such. I would check out any of our videos on policy design for information on that. But my point is, he can build in a lot of flexibility where he's billed for a very small amount and then add up to $100,000 at leisure. Let's look at this. So here we go. We saw option A. This is what he said no to. 4 years later, we connect option B, base premium, $10,000, PUA rider, $90,000, same out of pocket. So again, if you look at these terms and say, what am I looking at? Or it just feels overwhelming. This can happen to a lot of people. Annual funding with both of these examples is exactly the same. So a way this was explained to me once with respect to policy design was it's the same out of pocket to the client. We, the agents, are just designing it differently, but the client's paying the same dollar amount in. So we've got the same $100K per year for 5 years and then $40K per year through year 10. The difference is just where the money's going with these two. Here we've got less going toward the insurance premium, more toward the PUA rider. So what's the direct impact on this? Let's take a look. There's your first year cash value. Just about 87.5. Big difference when we look at that compared to the last example. What's highlighted in yellow is your break-even point between years 3 and 4 instead of 6 and 7. So again, this is the same policy with the same company, same individual, age 44 in both of these examples. So I reran this based on 44 just to make this an apples to apples comparison, but significantly more value up front. If we look at year 10, what do we see? Yeah, that's a big difference there, isn't it? So again, where we got this from, here was the $40,000 premium example. The product is a whole life 95. You've got a 44-year-old male. That was the health rating he received with this policy. And then we've got the same 44-year-old male, the same product. It's just designed differently. There's our premium. Instead of $40,000, this is the big piece right here. The lower you drive the premium, the more you'll see in cash value. Now, there are limits as far as how low you can go with the premium, which I talk about all the time. So I'm not going to go into all the details here. Otherwise, I'll just talk, and this video will be an hour long. But my point is, we reduce the premium. You will see some differences with the death benefit. There's an additional term here in this illustration. This is term insurance we attached to the policy, a very cost-effective way to add more life insurance. And this prevents what is called a MEC, a modified endowment contract, which triggers a taxable event. But same out of pocket, $700,000 over 10 years. So when we look at this, here's our cash value difference. So going back to his original goal, what was it? Or his original point of interest when it came to whole life insurance? Well, he was interested in being able to use the policy, specifically the cash value, as a line of credit, as a financing tool. He's been heavily involved in real estate over the years, does very, very well there, and he wants to continue to do so, but now he can use the cash value instead of going for outside financing or using cash. With the money in the policy, what he's attracted to with that is that it's forever compounding, where he can borrow against it, pay it back whenever, and the cash value is restored to what it would have been as if he never touched it in the first place. So he was interested in this, but not interested in a huge hit on his money. So by solving that problem, getting more money up front and long term for that matter, then now he looked at it and said, okay, I'm good with this. I understand how to maximize the cash value. Yes, there's a hit up front, but I understand the limits. I see how much I can minimize that upfront hit. Now I am interested in this. What are the next steps? So we see the cash value difference there, and it's much better from start to finish when we look at it. And one other thing too, and this is something that's often brought up with individuals who are analytical, and it's really brought up if you're ever speaking with someone that has a wealth advisor, a tax attorney, or it's a corporation and there's a CFO involved, is the guaranteed values. So here's the exact same comparison, but you can see this on the illustrations, any illustration. Sometimes you have to add it, but we've got the guaranteed values. There's the $40,000 premium example. Here's the $10,000 example. Actually, I've got to generate the guaranteed report, but that's all right. Let's just go back. All right. So here's our guaranteed values. Big difference here, isn't it? A lot of times this is not shown. And if a policy is designed properly and with one of the major mutual companies that has a track record of delivering stronger values than what's illustrated on the guaranteed side, like that's a good sign. We've always seen them do better than the guarantees, especially when it's properly designed. But with that said, in my opinion, it's still valuable to see the guaranteed values. I wouldn't want to take out a product, not see the guarantees, then have it disclosed to me after the fact. I would just say, hey, why did the person never show me this? Yeah, I understand that it should do better, but I would have liked to have just seen it or know where I can locate it. Because what you'll find with these higher premium policies, when you look at the guarantees, everything we just looked at on the last example, the non-guarantees, is amplified. So break even for that high premium example, $40,000. That's the high premium example. The break even is between 13 and 14 years. Whereas with the low premium, it's between 6 and 7 years. And you see a much more noticeable cash value difference. This is showing how much more or less you have in cash value with option B compared to option A. There you go as time passes. So he ultimately moved forward. That was his first policy. Around the same time, he took out a policy on his wife, and he's at a total of $590,000 per year in funding, where he's got policy number 1 on him, policy number 2, that's with a different company on him, policy number 3, that's for him, policy number 4 with the $50K per year, that's his wife, and then he's got 2 for his kids at $20K per year. That's where the total is. And just full disclosure, not all of these are with us. There's one of the kids' policies that are not with our company, but the other ones we did set up for maximum cash value, and I'll leave it at that. I hope this helps. I hope it answered some questions, particularly around setting up a policy correctly, because this, in the years of doing this, when someone's interested in whole life insurance, again, for the cash value, this is typically the major objection. How do I improve my cash value? Short-term, long-term, guaranteed, everything. The answer to the question is to reduce the base premium. Now, there's a lot more information and details we can get into if you'd like to see how dividends work on premium and PUA dollars. But the short answer is if maximizing cash value is the goal, reducing the premium will do so. And then the flexibility piece. So this was huge to him, especially if he's at $590,000 per year. If he's got minimal premiums, he can set up policies to commit to the minimum premium only and then add additional PUAs at discretion. This way, I don't feel like I'm on the hook for this huge bill every single year. So I hope this helps. Let us know if you enjoyed the video. Please hit the like button, subscribe for more. If you have any questions or comments, please leave them below. And as always, I hope this helps. Thanks so much.
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.